Well, the Yes Bank results were a big howler, and for everybody, all investors who had taken great succor at the last no divergence report of the Reserve Bank of India, this comes as a rude surprise. But the market had already had some suspicions that Yes Bank actually owns a lot of very questionable quality credit, and this is just in the face of it, which the new CEO, on taking over, is doing some kitchen sinking. I think there's a lot more to come, because IL&FS is not the only questionable credit which Yes Bank owns. There are exposures to other very dodgy groups, and over the course of the next few quarters, one fully expects to see much distressing news of the kind that we've seen in the current quarter. And therefore, the way to read the Yes Bank results is that on one hand you have the possibility and the real threat of fairly significant negative surprises over the next few quarters, and on the other hand you have an admission from the new management that this is going to be a time of strategic transition for the bank, coming away from the days of structured finance, which it was very keen on, and now to becoming a sort of a retail oriented bank. And these transitions are never easy, and they're time consuming, and therefore in the next 3 years growth will be very slow, as we've seen in the quarter gone by. So the combination of low growth because of strategic reasons and bad news because of the poor asset quality the bank still owns, I think it's quite conceivable that the next 3 years will be very difficult for investors to make money on the Yes Bank stock. This is going to be a colossal mistake if people go out and buy the Yes Bank stock today thinking that the worst is over, because the IL&FS part of it might be over, but there are many other groups in which Yes Bank has very significant exposure, and I fully expect that many of them will have to be provided for and will be classified as distressed assets and NPAs over the coming quarters. Now, it is in the interest of the new CEO to actually cut out or open up the market to all the bad news up front, because you don't want it to linger and fester. And Ravneet Gill's initial gambit with the first quarterly results suggests that he wants to get all the bad news out to investors so that he can start building Yes Bank once again from a clean slate. And therefore, I would suggest that the worst is not over for Yes Bank, not only from an asset quality point of view, but also from an operational point of view, because Yes Bank will struggle to cross 1% return on assets for a very long time, and its credit costs will remain quite significantly high, and therefore it is too early and too premature for investors to conclude that the worst is over with the debacle of this current quarter. Well, for a sector in which there is choice, there is no reason for people to stick on stubbornly to the mistake that they might have made in owning Yes Bank. You will note that the institutional participation in Yes Bank is very high. The ownership is very high. I think 40% is owned by FIIs. And therefore, a lot of people, I imagine, will now get impatient and throw in the towel and try to switch out of Yes Bank. So there will be a technical hangover on that stock as well for people who have stubbornly held on in the belief that asset quality is not as bad as the market fears it to be. Now the time for a switch has come, because people will throw in the towel. So given that technical hangover and the fundamentals problems that we have discussed, I think investors are much better off to say that if they want to own financials, they should either stick to the old tried and tested blue chip HDFC Bank, Kotak Mahindra Bank kind of stock. If they want to play the new credit cycle which is unfolding, then they should buy corporate banks like ICICI Bank and Axis Bank. And if they want to take a little bit more risk on the new corporate cycle, credit cycle, they can even own one or two very good public sector banks like State Bank of India. But that is the addressable universe of the quality banking space right now, because even names like IndusInd Bank will be scarred by some of the questionable quality papers that they own. So Yes Bank, given the choice for investors in the financial space of much better quality managements and a much cleaner trajectory of performance over the foreseeable 3 years, Yes Bank is a very difficult case to make for investment, and investors are much better off either selling out or opting not to own this company despite the fairly significant erosion in market cap which has happened after the quarterly results came out.